So in this video, we're going to talk about what are the common mistakes you will encounter when it comes to planning for retirement. Here you will see the chart that outlines from 20 years old to 70 years old how your career and your income will change over time. In the initial phase, you'll have a career boom where initially you might start off with a lower income, and as you work your full-time job, your income will be growing from 30 to 40 years old, and eventually you'll reach a peak. Now, for some of you, your income might continue to grow from 40 to 60, but that is really when you make the most money. Now, at that point, 60, 65 years old, you might decide to retire. And that's when you switch over to the remaining three income sources: pension, rental income, and investing. Now, one of the common mistakes I see is that most people, they don't do enough prep work and they switch directly to this retirement phase where you experience a much lower income here and they're not ready for it. For example, they might not have a good investing strategy and their income is not as predictable as they think. So this brings me to the next chart. You see that there's a little blue triangle here where you should start planning to save and invest at an earlier stage. So whether you decide to invest in real estate or the stock market, you want to start accumulating a nest egg over time and seeing how predictable that income source is and grow your portfolio as much as possible in the next 10 to 20 years. And if you have that amount of time, then you'll probably be able to retire comfortably. During this 40 to 60-year-old period, you also want to calculate your number. What is the number you're aiming for in order for retirement? Now, typically, when you are doing regular financial planning, you'll use something around 5% return or 10% return a year in order to calculate your retirement number. This will lead you to the realization that you might need $1 million, $2 million, or even $3 million in order to retire. But if you are able to use a more advanced strategy and get a higher return, then perhaps you can use less money and still retire with the same amount of income. So for example, for myself, my target is to get 30% return a year. And this is a pretty aggressive target, but because my target is higher than the average, then I assume my withdrawal rate is around 10% a year. So using a higher withdrawal rate, then I can reduce the amount of capital needed to put into the portfolio, and then which speeds up my retirement. So that brings me to the next diagram. If you are planning for an early retirement, then this means you should start saving even earlier. So here you can see I moved the blue triangle up, and by 40 you might have a sizable chunk, and if you calculate what your percentage gain is year over year, for example, times it by 5 or 10% or 30% in my case, then you will be able to retire at an earlier stage. So you might reach that number already based on your net worth. Now in this diagram, you'll also see that I have removed pension from this option because usually if you're retiring too early, I don't think you're going to get a large pension anyways. So you're mainly going to be relying on a combination of real estate and stock investing income. And finally, when you're looking at your stock investing portfolio, there's really two phases to it. The first phase, you want to lower the tax and focus mainly on capital gain and growth until you reach your number. Once you reach your number, then you want to focus on something called monthly passive income, where you're using your stock portfolio to generate a monthly passive income because you wouldn't be able to completely rely on your pension. So whether that is choosing a quarterly dividend strategy or you're using something more advanced like options or puts or whatnot, you still need to solve the monthly passive income problem. The reason is because when you have fixed expenses like your life expenses that you need to pay for, the predictability becomes very important. And if you have been investing in the market, you probably know that even the S&P 500 is quite volatile. You know what you're getting maybe over a long period of time, but you don't know what is the return you'll be getting next month. And that makes it extremely hard for you to rely on your portfolio for a consistent income. So that means between this 40 to 60 years old to 65 years old onwards, you actually need two different strategies, and you need to have tested and worked out, the risk management, how to pick these stocks, so on and so forth for both of them. That's why I think investing is quite difficult, and that's what I'm personally working on as well. So for the last 5 years, I have been using mainly a capital gain strategy. I have made a lot of videos on this part already, and if you go to my website, you'll also find the free case study where I talk more about my capital gain strategy. Now, after studying further, doing more experiments, I have worked out a pretty good monthly passive income strategy as well. It offers a lower return, but is still getting somewhere around 20 to 30%. So that's what I'm building out, because right now I'm in the early retirement phase, technically here, and then I need to transition part of my portfolio to what I call a monthly passive income strategy. So this involves selling puts and generating a more predictable monthly income. So the return might not be as high as a capital gain strategy, so maybe it's not like 40-50% a year, but then a monthly passive income strategy offers the predictability. So even though it might get 20 to 30% return a year, it still allows me to drastically reduce the amount of capital needed in order to retire. If you're planning for your retirement, the key lesson here is that you need both strategies, and you need to do the transition once you are comfortable. And you don't need to do the transition at 60. Obviously, you can do the transition earlier. For example, if you want to do it like 55, and you just switch over to a monthly passive income strategy earlier because you feel like you want to retire earlier, maybe you can work less, so then you have a less demanding work schedule, you can do that as well. But what's important is that you need to prove out both strategy, so then your portfolio grow very quickly in the beginning, and then switch over to monthly passive income and enjoy that benefit. Now, one more consideration you might have is the tax related to it. So for capital gain focused strategy, which is investing accelerator, the tax is almost zero. So you get compound tax-free increase year over year, and it is less maintenance as well. But for monthly passive income, it will get taxed like your salary. So then if you're making a super high income, like you're a doctor, you're an engineer, programmer, you work at FANG or whatever, then you need to be very careful when you implement this. So you just want to test, prove out, and make sure it works for you. And then once you decide to make the switch, then you allocate more to this strategy. If you do it too early, then you're going to be paying a lot of taxes. So for example, if you're making over 200K and your tax rate is like 50% or 40 something percent, then every dollar you earn for monthly passive income, half of it is going to go to the government. So you're not really getting that benefit. And if you calculate your after-tax return, it might end up be the same as holding on to S&P 500. But there's a very different implication here where you know what income you're getting on a monthly basis, and that predictability is what you need to retire. So if I just recap this video, what you need is a way to grow your portfolio very quickly, whether that is stock or real estate, depending on your skills, and a way to generate cash flow with the least amount of capital. So those are really the two requirements I see you need in order to retire. And then whether the capital is coming from saving, your salary, or it's a line of credit, once you are able to prove out the strategies, you can decide where the funds come from. And one final consideration is that when you decide your number, how much monthly passive income you want, and you work out what is the portfolio balance you're aiming for, and you know that, hey, this is the amount of portfolio I need, and this is the monthly passive income I want, then you do want to include some buffer room. So just because you reach that number, it doesn't mean you want to quit right away. You want to keep saving and exceed that number, because you don't want to have a bad year and suddenly you go back to the workforce and you start working again. So let me give you a quick example. So let's say you're aiming for 5,000 a month, and that is 60K a year. And if you are looking at a regular portfolio that makes around 5-6% a year, you will need $1 million in your portfolio. You can already talk to your financial advisor to work it out. But let's say you're able to make 20 to 30% using a monthly income strategy, which requires more advanced knowledge. So that means if I take out my calculator, 60,000 divided by, let's say, 0.3, which is 30% return, that means you only need 200,000 to allocate to a monthly passive income strategy in order to reach your retirement goal. So this is much more realistic. It is easier to achieve over the course of your 40 to 60 years old period, or even 30 to 50 years old if you want an earlier retirement. But you don't want to stop there. Once you reach this 200,000, fantastic, you know you can retire, give yourself a little bit more buffer room, right? You want to, let's say, exceed this number. So in the event where you're not getting rent from your rental properties, or your monthly passive income strategy is not performing as well, then you still have some buffer room. So let's say you want to double that, 400,000. So this is the number you would need to target in order to retire. So which is still less than $1 million, which I believe is fantastic, because I think saving $1 million is actually really difficult. Of course, it can be done, but usually it will take 20, 30 years in order to get there. So then the question is, well, what does it take to get to this $400,000? So if you're able to make, let's say, 20 to 30% return a year, then that means every 3-4 years, you'll double your account. So then if you divide it by 2, so that means 3 years ago or 3 years from now, you need to start with 200K today. And if you divide it by 2 again, then you need to start with 100K today. In 6 years, you'll be at 400K without adding any additional money. So that's how you work out a retirement plan. Now, of course, this has a lot of simplifying assumptions. It doesn't include your saving rate, which is why I have a retirement calculator, which is a whole series of 5 YouTube videos as well. So you can refer to that. But basically, this is the quick and dirty back of the napkin calculation for income streams and retirement. So if you're interested in learning more about how I target a higher return in the market, then you can click on the link below to get to the free webinar called How to Get 30% Return a Year. So it is in the description, or it's below this video, so you can click on the link. Even if you're busy right now, you can just register for it first, and I'll send a reminder to you shortly.